What if everything you've been taught about the stock market is only half the truth? Most people believe the stock market is simple. When companies perform well, their stock prices go up, investors make money, and everyone benefits. It sounds fair, logical, and easy to understand. But if that's really how the market works, then why do stock prices often hit all-time highs while millions of people struggle with inflation, rising living costs, and stagnant wages? Why does Wall Street celebrate record-breaking gains while Main Street worries about paying next month's bills? The answer is that today's stock market has changed dramatically, and the rules that worked decades ago are no longer the only forces driving prices. For generations, Americans have been told to work hard, save consistently, and invest in the stock market for the long term. This strategy has helped millions of people build wealth through retirement accounts like 401ks and index funds. In theory, companies innovate, generate profits, expand their businesses, and investors share in that success. It's a system that has created some of the greatest fortunes in history. But today's market often behaves in ways that seem disconnected from the real economy. A perfect example is Tesla in 2020. During the COVID-19 pandemic, businesses were shutting down, unemployment reached levels not seen in decades, and uncertainty filled the global economy. Yet, while many companies struggled to survive, Tesla stock surged by more than 700% in a single year. At the time, many analysts argued that the company's market value had grown far faster than its actual profits. Investors weren't buying Tesla because of what it was earning that year. They were buying the dream of what it might become in the future. This example reveals an important truth about today's market. Stock prices are no longer driven only by current earnings or economic conditions. Investor expectations, future growth stories, institutional money, and massive flows of capital can push valuations far beyond what traditional financial models would suggest. Understanding this shift is the first step towards answering the biggest question of this video. Is the stock market really broken, or have the rules of the game simply changed?
One of the biggest reasons the modern stock market feels disconnected from everyday life is that it is no longer driven only by company profits or the strength of the economy. Today, stock prices are heavily influenced by central bank policies, interest rates, and the amount of money flowing through the financial system. When the Federal Reserve lowers interest rates, borrowing becomes cheaper for businesses and investors. At the same time, savings accounts and bonds offer lower returns, encouraging people and institutions to move more money into stocks. This extra demand can push stock prices higher, even when many people are still struggling financially. A perfect example of this happened during the COVID-19 pandemic in 2020. As the virus spread across the world, millions of Americans lost their jobs, thousands of businesses closed, and the U.S. economy entered one of its sharpest recessions in history. Many expected the stock market to remain depressed for years. Instead, the Federal Reserve cut interest rates to near zero and launched massive stimulus programs, while the U.S. government approved trillions of dollars in economic relief. As a result, a huge amount of money flowed into financial markets. The S&P 500, which had crashed by nearly 34% in March 2020, recovered within months and eventually reached new all-time highs. Meanwhile, many families were still dealing with unemployment, rising living costs, and financial uncertainty. This example highlights an important lesson. The stock market and the economy are not always the same thing. The market often reflects what investors believe will happen in the future, while the economy reflects what people are experiencing today. That's why Wall Street can celebrate record highs, while Main Street continues to face financial challenges. Understanding this difference is essential if you want to understand how the modern stock market really works.
When most people imagine the stock market, they picture millions of individual investors buying and selling shares from their phones or computers. While retail investors have become more active in recent years, the reality is very different. The vast majority of money in the stock market is controlled by hedge funds, mutual funds, pension funds, insurance companies, investment banks, and giant asset managers like BlackRock, Vanguard, and Fidelity. Together, these institutions manage trillions of dollars and have the power to move entire markets with a single investment decision. They also use advanced technology, artificial intelligence, and high-frequency trading algorithms that can analyze market data and execute thousands of trades in just a fraction of a second, something no ordinary investor can compete with. A powerful example of this occurred during the 2010 flash crash. On May 6, 2010, the U.S. stock market suddenly collapsed within minutes. The Dow Jones Industrial Average plunged nearly 1,000 points, about 9%, before recovering much of those losses shortly afterward. For millions of investors watching the market live, it looked like the financial system was falling apart. Later investigations revealed that a combination of a large sell order and high-frequency trading algorithms amplified the panic, causing computers to rapidly buy and sell stocks at incredible speed. The crash wasn't driven by terrible company earnings or a major economic disaster. It was largely the result of how modern trading systems interacted with one another. This event exposed a reality that many people had never considered. Technology and institutional investors can sometimes have a greater impact on stock prices than the actual performance of businesses. When giant funds move billions of dollars or algorithms react to market signals in milliseconds, prices can swing dramatically before ordinary investors even have time to respond. Understanding who truly controls most of the market helps explain why stock prices often move in ways that seem confusing or even irrational to everyday investors.
When most people think about a successful company, they imagine one that invents better products, increases sales, hires more employees, and earns bigger profits year after year. While those things are certainly important, there's another strategy that many of the world's largest corporations use to boost their stock prices: stock buybacks. A stock buyback happens when a company uses its own cash to purchase its own shares from the open market. As those shares are removed from circulation, the total number of outstanding shares decreases. This means the company's earnings are now divided among fewer shares, which increases earnings per share. Since many investors closely watch EPS, a higher figure can make the company appear more profitable, often leading to a higher stock price, even if the company's overall profits haven't changed very much. One of the best examples is Apple Inc. Over the past decade, Apple has spent hundreds of billions of dollars buying back its own stock, making it one of the largest share repurchase programs in corporate history. Imagine Apple earns $100 billion in profit and has 10 billion shares outstanding. That equals $10 in earnings per share. If Apple buys back 2 billion shares, leaving only 8 billion shares outstanding, the same $100 billion in profit now becomes $12.50 in earnings per share, even though the company's total profit hasn't increased at all. Investors often view the higher EPS as a sign of stronger performance, which can help push the stock price even higher. Supporters argue that buybacks are a smart way to return excess cash to shareholders when a company has no better investment opportunities. Critics, however, believe some corporations spend too much money boosting their share prices instead of investing in research, innovation, new factories, or higher employee wages. This debate shows why a rising stock price doesn't always mean a company is creating more real economic value. Sometimes it's the result of financial engineering rather than business growth. Understanding stock buybacks is another key piece of the puzzle in explaining why today's stock market often behaves very differently.
One of the most surprising patterns in modern finance is that economic crises often make wealthy investors even wealthier. At first, this sounds impossible. After all, recessions, market crashes, and financial uncertainty hurt almost everyone. Businesses close, unemployment rises, and consumer spending falls. But the biggest difference between ordinary people and wealthy investors isn't just income, it's access to capital. During a crisis, many families are forced to sell investments or use their savings just to pay rent, mortgages, or everyday expenses. Wealthy investors, on the other hand, often have large cash reserves and can afford to buy valuable assets when prices are falling. As legendary investor Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." A powerful example is what happened during the COVID-19 market crash in 2020.
Between February and March 2020, the S&P 500 fell by nearly 34% as fear spread across global markets. Millions of investors panicked and sold their stocks, believing the economy was heading into a long recession. At the same time, several billionaire investors and large investment firms saw the crash as an opportunity rather than a disaster. They purchased shares of high-quality companies at heavily discounted prices while fear dominated the headlines. As governments introduced stimulus programs and the economy gradually recovered, the market rebounded far faster than many experts had predicted. Companies like Amazon, Microsoft, and Apple reached new record highs, and many investors who bought during the panic earned exceptional long-term returns. According to reports, the net worth of several of the world's richest individuals increased dramatically during the recovery because much of their wealth was invested in appreciating assets. This doesn't mean every wealthy investor always wins, or that every crisis creates guaranteed profits. The lesson is much simpler. Those who have capital during times of fear often have the greatest opportunities. Financial crises don't just destroy wealth, they also transfer wealth from those who are forced to sell to those who are financially prepared to buy. That's one of the biggest reasons wealth inequality often grows after major market downturns. Understanding this pattern helps explain why the stock market can recover quickly, while many ordinary families take years to recover financially.
After everything we've uncovered, one thing should be clear. The stock market isn't simply a mirror of the economy anymore. It has evolved into a complex financial system influenced by central banks, institutional investors, artificial intelligence, algorithmic trading, corporate buybacks, and global capital flows worth trillions of dollars. That doesn't mean the market is rigged, and it certainly doesn't mean ordinary investors can't succeed. It simply means that today's market rewards those who understand how the system works instead of blindly following headlines or social media hype. The rules haven't disappeared, they've changed. And the people who recognize those changes are the ones most likely to build long-term wealth. A perfect example is Warren Buffett's investment in Coca-Cola. In 1988, after the stock market crash of 1987, Buffett saw something that many investors overlooked. Instead of chasing the latest trend, he invested over $1 billion in the Coca-Cola Company, believing it had one of the strongest brands in the world and would continue growing for decades. Many people thought paying that much for a soft drink company was risky, but Buffett focused on the company's long-term competitive advantage rather than short-term market noise. More than 35 years later, Berkshire Hathaway still owns a massive stake in Coca-Cola. And that investment has generated tens of billions of dollars in gains and billions more in dividend income. It became one of the greatest long-term investments in history, not because Buffett predicted every market movement, but because he understood the power of patience and quality businesses. That's the biggest lesson from this entire video. The investors who consistently succeed aren't necessarily the ones with the most money or the highest IQ. They're the ones who keep learning, ignore emotional market swings, and think in years instead of days. Markets will continue to rise, fall, crash, recover, and surprise everyone. New technologies like AI will create new opportunities, and economic crises will continue to test investors' emotions. But one principle has remained true through every generation. Knowledge and patience are two of the most valuable assets an investor can own. So the next time someone says the stock market is broken, don't rush to agree or disagree. Instead, ask yourself a better question. Do I truly understand how the market works? Because in today's financial world, understanding the rules of the game is often more valuable than trying to predict the next big winner. If you enjoyed this video and learned something new, don't forget to hit the like button, subscribe to the channel, and turn on the notification bell. We create in-depth videos that uncover the hidden truths behind money, investing, business, and the global economy. Thanks for watching, and I'll see you in the next video.